Hey everyone, welcome back to Accounting Simpler, your partner in accounting education. Ever wondered how a company buys a huge, expensive machine, but doesn't just write it off as a massive expense in one go? It seems weird, right? Well, that's where a super important accounting concept called depreciation comes in. When a business buys a major item, like a delivery van or a computer system, it's considered capital expenditure. These items are called non-current assets. Instead of expensing the full cost immediately, they are listed on the company's statement of financial position. But here is the thing, that van is not going to be worth the same amount 5 years from now. It loses value over time. This gradual loss in value is what we call depreciation. Think of it as a way to systematically spread the cost of an asset over its useful life. To do this, we first need to figure out its depreciable amount. This is simply the original cost of the asset minus its estimated residual value. Residual value, or scrap value, is just what the company thinks it can sell the asset for at the end of its life. So, why do assets depreciate in the first place? There are 4 main reasons. First, physical deterioration. This is your classic wear and tear. Using a machine every day or a truck being exposed to rain and sun causes it to break down. Second is obsolescence. Technology moves fast. A new, more efficient model comes out, and suddenly your perfectly good machine is outdated and less valuable. Third, the passage of time. This is especially true for things like patents or leases that have a specific expiry date. Once that date passes, their value is gone. And finally, depletion. This applies to natural resources. Imagine a piece of land that's valuable because it has oil underneath. As you extract that oil, the land itself becomes less and less valuable. So why is accounting for depreciation so crucial? It boils down to 2 key principles. The first is the matching principle. This principle says that you should match your expenses to the revenue they help generate in the same period. Since an asset helps generate revenue for several years, depreciation allows you to spread its cost across those years. The second is the prudence concept. This is all about not overstating your assets or your profits. By recognizing that an asset has lost value, you're presenting a more realistic and honest picture of the company's financial health. You're acknowledging the loss in value and adjusting your profits accordingly. And that's a quick rundown on depreciation. It's a fundamental concept that helps businesses paint a true and fair view of their finances.